About your explanation here, because we heard people earlier this hour, they were saying, look, don't worry about oil. It's a thinly traded futures contract. It's a technicality. The energy's holding up okay. The credit's okay. You're saying, no, this is a real thing happening in the real world. People are paying minus $40 to minus $60 a barrel all over the place. What do you think is going on here?
Well, it's simply the demand story is so epically enormous that we're having a problem with managing the actual physical reality of crude. You know, typically the industry runs on a just-in-time basis, produce a barrel, move a barrel, refine a barrel, consume a barrel, and suddenly we have 35 million barrels a day to try and handle, and it becomes impossible, quite frankly, and that's why the prices can go to almost any level. You know, it's just unknown what will happen over the next month. I think the point we were making this morning, Kelly, is simply that there's another month still to go. That's what's concerning. So we've already hit these extraordinary lows, but we're not out of the woods by any means yet.
You know, Jeff Curry of Goldman had a slightly different look at it yesterday. He said that he thinks the peak week globally for demand destruction was last week, and that by June you could start to be in a deficit situation again. Would you also say that's possible, and you're just saying it's going to get a lot worse in May before June gets better, or do you have a fundamentally different view?
No, we're similar. I mean, we're watching Google mobility, we're watching Apple mobility data, which is fantastic because it's so up to date. I think the staggering one is India, down 80% in terms of mobility. But yeah, I think it's fair to say that we're somewhere near the lows if we begin to open up this week. I was surprised that there's not been more of an uptick in Spain and Italy. You know, that they've opened up slightly, but their mobility trends remain extremely negative, down 85, 90%. And there's actually no sign of the uptick that you read about when you read that they were opening up slightly.
Wow, which doesn't bode well for here, for people being eager to get out and go. That said, you do still have a pretty bullish view on demand for crude in the back half of the year because prices are so low. So the December contract is trading around $32. Is that a world that you think is going to be a reality? And again, people need to know this is not like the stock market where it's a constant discounting operation. It's the cash price, like Curry keeps saying. So, you know, it has to clear at these ridiculous levels before we can get to $32 a barrel. But does 32 seem doable for you? And if so, is that why the equity and the credit isn't more upset right now?
Yeah, I mean, typically the equity market, the debt market for that matter, which is actually quite disconnected from the equity. The equity market for oils is much more positive than the debt market. But it's notable yesterday that oil debt didn't trade down in the way that crude did. It couldn't have, but nevertheless has actually held up yesterday, regardless of the price. I think the point, Kelly, to be clear, is that the second half of the year we think will be exceptionally strong for gasoline. Our regressions show that the most important single driver, not car choice, not Tesla penetration, not efficiency of cars, not even employment, but actually simply price of U.S. gasoline really drives consumption here. And so we're looking for a big second half that, if the refiners retain their discipline, will mean huge refining profits. The issue is that if the refiners retain discipline, it's not a huge increase in crude demand. So I think the 30 is fair, absolutely, but I don't see it much upside when you've got so much inventory and so much spare capacity in OPEC, and by then in US E&P as well, because we'll have to shut down a couple of million barrels a day of US oil and gas production here over the next literally 4 or 5 weeks.
You know, a lot of people will say when you're dealing with a crisis like this to bet on the biggest companies, but you're worried about some of the biggest oil companies like ExxonMobil and ConocoPhillips being the hardest to fall. Why is that?
Oh, just simply because the scale of losing money here is so epic that the bigger you are, the more money you lose faster. So their debt, you know, will increase massively, not against, obviously, their more powerful balance sheets, but just in absolute terms. The issue for both of them, I think, also important is that they don't hedge, nor does Chevron. So whereas many of the smaller E&Ps are hedged for 2020, although not for 2021, the fact is that this will just be absolute losses and absolute deterioration of balance sheet for the biggest names, who obviously in absolute terms will see the biggest deterioration in increases in debt, deterioration in balance sheet over the next 6 to 8 weeks.
And like you said, you've been met with a lot of skepticism for suggesting that Conoco could merge with the likes of Chevron. But talk about some of the possibilities that might emerge here from these companies being absolutely battered by this price shock.
Well, you know, the first line is always that it's a question of an oil company calling another one to sell itself, not the other way around, although it didn't quite work like that with Oxy Anadarko. But nevertheless, typically deals are friendly, and that's really where we were coming from on the Conoco idea. I think that the premium assets, which are in the Permian, we see Guyana as being obviously a long-term, highly attractive asset. those are all still investable in terms of one company wanting to buy another. But there's a whole swathe here of assets, particularly you'd say North Dakota, Oklahoma, not the Permian in Texas, which likely will be significantly smaller going forward and never really return to the glory days again until really these companies have been rationalized. And when they are, there'll be less of them. And so really, we're going to see, unfortunately, a structurally smaller U.S. oil industry going forward after this disaster, I'm afraid to say.
Wow, and I imagine even with any kind of government support we might see, this is just too overwhelming of a move. Paul, it's great to hear your views. Thank you. Hope to check back in with you soon. Paul Sankey of Mizuho on the crude collapse today. Well, the June contract, which we're rolling over to after today, that one's now sitting at session lows. So it's the second one on your screen there, and it's trading under $10 a barrel. This is the one that was supposed to be the real price, quote unquote, and it's below $10 a barrel. But with all of these losses across the board, it's not all bad, according to my next guest. Joining me now.